Hello, everyone, and welcome out to this Market Master class on management on winning trades. We're going to go through when you're in a winning trade, what that means in terms of risk, reward, probability, and we're always weighing these factors. What this class is not going to be is to tell you exactly what you should do in every single trade you take because every trade is constructed a little differently. It's different when let's say that I had a trade where I can make 3 and I'm risking 1, right? Here's my reward and here's my risk. Am I going to manage that differently than if I have a trade where it's a 1-to-1 reward to risk ratio? Well, my thought would be yes, I am going to manage that different. Would it matter whether it's a vertical spread or a butterfly or different styles of trades, ratio back spread on how I'm going to manage it? Yes, because all of those have different probabilities of success in terms of what you're trying to accomplish. So if I have a 1-to-1 reward to risk ratio, here's kind of my philosophy in a nutshell. You can't take small profits. You cannot take, say I'm going to make $1 and risking $1. Here's what won't work. You can't take profits when you've got 30 cents in your pocket and then risk the full dollar when it doesn't work out. That math will not work. You can't lock in 30 cents of profit for $1 at loss with this type of reward to risk ratio unless you're just, killer on your probability. If you get it right, 80%, 90% of the time, well, you can probably pull this off. But with a 1-to-1 reward to risk ratio, the trade's probably starting in the market's mind at about a 50% probability of success. Yeah, you might be better than that. You might have a 60% hit rate, but you can't, if you make 6 profits times 30 cents and you lose 4 times at $1, that math is not going to work, right? You're going to lose $4 for losing trades at $1 each. You're going to make 6 profits at 30 cents each. That's only $1.80. You're underwater. So that concept will not work. We can't take small profits and big risk when we have a reward to risk ratio that's around even. Well, what about over here? Can I take it off? Well, if I can make 3 and I'm risking 1, well, now all of a sudden it might make sense to lock in $1 of profit. I've made what my original risk was, but do I want to lock it in on everything? No, probably not, because this started with a less than 50% probability of success according to the market's mind anyway. In the market's mind, if they're giving you a 3-to-1 reward to risk ratio, then they're saying, well, your probability of success might be, 30% or whatever, right? So if I have a 30% hit rate and I lock in 1 profit and I have 7 trades that go against me and I take a $1 loss, that math's not going to work either. So there have to be some approaches, some concepts to how can we maximize profit, minimize risk, and stick with this dynamic, because this seems to be one of the biggest mistakes I see people make is they just don't think about the risk to reward of the original trade once they're in the position. They don't think about the probability of success when they put it on now that they're in. All they see is, well, I've got $1 of profit. I've got 30 cents of profit. If I don't, then I'm going to regret it. I'm going to sit there and kick myself with the would-haves, could-haves, should-haves, and, really miss out on opportunities because this is going to go back and I'm going to end up losing. And, they start thinking of all these worst-case scenarios, where in reality, you had good reward to risk. You might have had a good probability of success. Now, let's stick with the plan. Let's manage that plan as best we can. And if we're going to veer from that, there ought to be a good reason to do so. So, again, I'm not going to give you there is no perfect science to it, but make sure in your trading plan you really consider these concepts that we're going to talk about. So, when you're in a winning trade, you've got to look at it objectively. You can't look at it emotionally. If you start looking at the dollar signs, you're going to make an emotional decision. You're going to say, well, I'm up. It feels good. You're going to start telling yourself I can't go broke taking a profit, that's really bad advice, because you can absolutely go broke taking profits. Why? Because if you take quick profits on all your winners and you let your losers grow big, that's not going to work. So any adjustment, anything that you change from your original trading plan should be carefully analyzed. Watch out for emotions, because when you have dollar signs flying around, when you know I'm up, $500, and you start counting the money, I'm up $1,000, and so on. There's an emotional attachment to money. There just absolutely is. Don't believe me? Go look at the cause for divorce in marriages and so on. You will be emotional about the money. You can't avoid that. What you can do is protect yourself through sticking with the plan, through analyzing everything objectively, and making sure that you're not making impulsive emotional decisions. So, one of the concepts that traders look at is trailing stops. Now, this is more perhaps on a stock basis than options. I don't personally love having live stop losses out there on most of my option trades. But the concept is a trailing stop is basically locking in gains, keeping your winning trades for as long as you can, but allowing something to run. So, the idea here would be, well, I'm in this bullish trade. Let's draw up a hypothetical scenario. So this stock is based and breaks out to the upside, and I buy call options. So I'm long the calls, and it starts to work in my favor. Fantastic. I don't want to cut that off, and it kind of pulls back, and then it comes up again. Well, the idea is I want to lock in gains, but I also want to let this run for as long as it's going to run. So I want to stay in for as long as possible. If something truly changes, then I want to take profits. I want to lock in those gains. So the concept would be, well, maybe I would have moved my stop loss up right here to break even. Let me change the color on that. Let's do our stop loss in a red. I lock in a break even stop loss as this thing worked in my favor, right? I move it up to break even. And then it pulled back and it went higher, and so I move my stop loss up to that new level. And then as the market kind of bases and so on, I say, okay, do I want to take profits? Well, it might go again, and it starts to break out. So now I trail my stop loss up below that level. The whole idea is I want to lock in my gains. I want to make sure it's a gain, but I want to let it run, and I want to protect against, market corrections, a big swoon. And all of a sudden, as you start to get more and more extended, you might decide, boy, I'm up a ton in this, and it's going parabolic. I know a parabolic move can't continue forever, right? And I know maybe it will until expiration on this. Maybe I can keep squeezing it out, but at some point the music stops, I suppose. And I don't want to trail my stop all the way back here below this swing low. That seems too far away. So at that point, you start trailing it up, and maybe you move it up here, below a couple of days ago. It goes a little higher, and you just start manually adjusting that up. That would be the concept. When you're ready, when you basically say, okay, it's extended away from these factors, I'm not really wanting to give it space. At this point, I'm well past my profit target and so on. You might just start to really trail that up. And then the idea would be it gets you out of the trade when this thing reverses and goes back down, but it sold you out. It locked in the profit up here so that as it reversed hard, you don't have that. That would be the great way that stop losses work. Here's the bad way that they work, right? Same exact concept, except, now we get in, this base is sideways. I'm going to do the same thing. It breaks out to the upside, and we jump into this position. And we move our stop loss up to break even, somewhere right in here where we got in on the breakout. And lo and behold, the trade comes down and stops you out. Or Let's say it doesn't, hopefully it just goes back up and it kind of bases here. And you decide, okay, definitely moving my stop loss up. If you didn't get stopped out there, now you've locked in some profit, but it turns a little choppy in here. It just kind of whipsaws just enough to kind of stop you out, and then it works its way higher, and you miss out on that parabolic move. Anytime you're moving a stop loss, you're at risk of it stopping you out prematurely, of basically that whipsaw where it's just choppiness, what we call market noise, but that market noise could hit the levels where it stops you out and you miss out. If you got stopped out here at break even, you missed out on that entire run. You had analyzed the run, but just the market noise got you out. And that's always a risk when you're in the trade, is that trailing the stop, if you're too tight with the stop, then just that choppiness will kind of potentially chew you up and spit you out, get you out of the trade too early. But that's one concept of, if I have a winning trade, can I lock in those profits by moving the stop? If it's a stock, it's really easy, and that's usually where I would use a trailing stop more, as if I were in some stock trade. If I'm in a long call or a long put, I might use the same concepts, but depending on what it was, if I was in SPY or QQQ, they're so liquid, they trade so many 100 million shares per day, their options are, the bid-ask spreads are within pennies. I've got no problem putting a live stop loss on a long call or a long put. But if you're in some XYZ that doesn't trade much, and the bid-ask spread on your calls are $2 bid and $2.40 ask, 40 cents different, big wide spread, then I don't want a live stop loss on that. Because what a stop loss does is, when it's triggered, it's going to get you the worst of these two prices. It becomes a market order. So even though the midpoint is 220, and that's kind of fair value, you'd be selling out for $2. You'll always get the worst price, and on an illiquid stock, that's a problem. If you stick with the highly liquid names like SPY, QQQ, the sector ETFs like XLE, XLF, if you trade big name, high volume stocks, the Intels and the Microsofts of the world, you can use live stop losses, because those bid-ask spreads are going to be, instead of $2 by 240, it's going to be $2 by 203, and 3 cents difference. Yeah, you might have been able to split the bid-ask spread for 201 or something, but I'm fine with that concept. I'm fine with getting 1 cent less than what I maybe would have, could have, should have. So those are some concepts that you can look at for trailing stops. Let's talk about the normal process for moving stops. You don't want to be in the market path usually. The exception being at that last part. Remember I said when it went parabolic, you might have started to trail it up far more aggressively. But before that, you really want to stay out of the stock's way. You don't want the choppiness to get you. So when you're moving it more aggressive and you want a tighter stop, traders will often use a 1.5 ATR to lock in gains. So they can move the stop up to break even, and when they want to be more aggressive, trail the stock by 1.5 ATRs. That's a concept that keeps you outside of normal volatility. A 1 ATR is how much it averages per day. So 1.5 is 150% of its normal movement. In other words, the stock's going to have to make at least a directional move over probably a couple of days against you before the stop loss is triggered. So you're not getting out on just choppiness. Let me give you an example of what this means. So let's take a request. Anybody have a stock? I'm just going to look at your stock that you type in here. So type it in the chat box while I pull it up. I'll take the first come, first serve here. Okay, Rick says Abbott Labs. Perfect. ABT. Let me pull this up. We'll go Abbott Labs. And, well, perfect example. Okay, Nice example of something that's definitely running higher. You can see the breakout. You can see the nice move that it's in. Imagine you were in this trade and looking at potential stop loss areas and so forth. You got to consider the normal volatility. So if I come down here, I'm going to add the ATR, average true range. It defaults to 14 periods. I click OK. Now the ATR reading is going to be true to the stock you're trading. So for Abbott Labs, it tells me that Abbott averages $1.21 movement per day. Now that's entirely different than any other stock. If I change it to Microsoft, the Microsoft averages $1.89. If I change it to Amazon, it's a very high price stock. Amazon averages $35.87 per day. But the important thing is that we need to manage our trades according to the stock that we're trading. So for Abbott Labs, if you wanted to trail a stop, you would look at this concept and say, okay, $1.21 is its average daily movement. I'm going to multiply the ATR by 1.5. Okay, I'm going to basically take that ATR and add another 50% to it, right? So if you take out your calculator and you say, okay, well, it averages $1.21, and I'm going to multiply that by 1.5, so 1.21 times 1.5 equals 1.815. Let's call it $1.82. $1.82 is 1.5 ATRs for this particular stock. And that's what traders refer to as a volatility stop. The concept being that I want to be outside of its normal choppiness and not get stopped out too early, but really only get stopped out if there's a significant, a move against me that has real substance to it. So if we were looking at this trade, it's a really good example of how a stop loss should hopefully work, because you get in the trade here at, let's say you got in at 74, 70 or whatever. Let's say that's your entry point. Well, if you got in at 74.70, if you put your stop $1.82 away, that's outside of its normal fluctuations, where would your initial stop loss be in theory? Well, if I enter at 74.70, I subtract the 1.5 ATR, so I subtract $1.82. My stop loss was at 72.88. So let's change it to red. Here's my initial stop loss at 72.88. Now, the trade starts to go in my favor. I bought at 74.70. Well, actually, it kind of went down here, but notice that choppiness didn't stop you out. It didn't hit 1.5 ATRs. It starts to work its way higher, 75.50, 76, 76.50, 77, and so on. And you could be trailing it up. And right now we're hitting 78. So at 78, if I wanted to trail up the stop, again, I can look down here at a 1.5 ATR and say, okay, well, if the shares are up here at $78 per share. Now I realize it's 77.98. Let's be specific, I guess. 77.98 minus $1.82. You could have a stop that's basically at 76.16. Your stop loss would be right here if you were trailing it up. And if you got into the trade at 74.70 and it's up here, it allows this trade to keep working, to keep running. Is it at risk? Yeah, it's at risk, because if this stock decides to chop around and trades down here, it's going to stop you out. And so you're going to make that difference, which isn't a huge return. But the idea behind the trailing stop is I can trail it up while I need to. At any point in time, though, can I make a different decision? Could I go, you know what, rather than wait for it to come and stop me out here, it's hitting my target at 78. You know what? I'm just going to take profits here at 78. 78 is what I was targeting. I'm going to lock that in, and that's $3.30, right, of profit, because I got in here and I'm selling it out right here. And based on my original risk, I got into this trade at 74.70, and I put my stop loss at 72.88 originally. I, of course, had $1.82 of risk, locking in 330 right here. That might make sense. So I don't have to keep using a trailing stop, but I could use it for some of the initial move and then take profits into the run. Okay. Again, that's a concept for trailing a stop and allowing winners to run, staying outside of that normal volatility. And the beauty of this is that it's using the stock's personality. It's using the personality specific to that name. Now, let's jump over here, and I wanted to talk about what happens when things change. Whoops. What happens when things change? We talked about the stop loss area, hit that hard. What happens when you want to shift the position? Well, a lot of times too many adjustments becomes a detriment. You don't want to adjust just for the sake of adjusting. Sometimes when you learn about options, you tinker too much. You don't want to be in that situation. You want to stay true to the risk and reward and probability. And this is what I talked about at the start. You don't want to turn a 1-to-1 reward to risk ratio where you start taking tiny profits and big losses, because that math just will not work. So let's think about this from the standpoint of, could we take profits on half of the position and leave the other half to run? Or another concept is actually to just leave it alone. Just position size for max risk and max reward, because you like the risk reward probability when you got in this trade. The only way for you to get these results is for you to stay in it from now till expiration. Then all of this stayed the same. If you do any adjusting, if you take profits on half of the trade, well, that changes things, right? That doesn't stick with the original risk and reward. So could there be times where locking in some gains makes sense? I think there can be, but on a specific style of trade. For me, if I was putting on, again, a trade that had, let's say, a vertical spread, I just buy an 80 call, I sell an 85 call or something like that. I buy a bull call spread. Okay, I buy this one, I sell this one, and I've got a reward to risk ratio of 250 to 250. I have to manage this one of two ways. Either A, I'm just leaving it alone and I'm going to get this reward or that risk. Okay, that's one option. Or B, I can manage it, but I have to manage the risk. It's okay to take less profit as long as you're taking less losses as well. So if I B, manage the risk, well, maybe this 250 loss, I'm going to cut it off if it drops to 170. If I'm going to lose 80 cents, that's my targeted loss. That's how much I'm willing to actually lose in this. Yes, my max is 250, but I'm saying if it drops to 170 in value, I'm going to lock it in at an 80-cent loss, and that's as far as I'll go. But B, that's where I could take profits, because if I'm going to keep my loss at 80 cents, well, what if this thing grows to, $4 of value? Well, now I can lock in $4, or I can lock in $1.50 profit. Does this math work? Absolutely. If I'm going to keep my loss at 80 cents, does it make sense that I can lock in a reward of $1.50 on the trade? Yes. So management works as long as you're not leaving the risk side exposed and taking small profits. And that's, again, where I see people make mistakes, is they say, well, I'll just, anything that's got a profit, I'll hurry and lock it in. And if it doesn't have a profit, I'll wait for it to come back. Well, good luck with that, because some of those are going to turn into max losses, and, the math just doesn't tend to work out. So those are some of the risks. Now, this is the end of the PowerPoint here. Just in conclusion, be wary of emotions, adjusting trades when the markets change. Look to adjust stop levels consistently. Make sure that you're following your plan. Consistency of doing that, so important. Now I want to brainstorm here a little bit, and let's go through some of these concepts of when could it make sense to manage and do some things with the trade. So I had an example here. What was I on? No, my monitor. Let me jump over here. What was I on messing around with? UPS. Okay. UPS is trading at 110 per share, and this is not a recommendation. This is just to show some concept. So if I have UPS, and let me back up. Let me redo all of this. So this is just a screw around account. Let's go. Where am I at here? Let's just rebuild it, okay? So I'm going to go like this. I'm going to say we build a call butterfly. So I'll right click, I'll buy a butterfly for UPS. Now, it might look like this, right? So I'm going to buy the let's do the 100, 110, 120 call butterfly in April, hypothetically, right? So I've got a $10 wide call butterfly, and the trade comes out to just under $5 cost. So I've got a reward to risk ratio that's about 1 to 1. I'm going to right click, I'm going to hit analyze trade, and then as I do that, I can even set, so here it came up. Let's remove one of those. We don't need it to be redundant. Let me just delete that. Okay, now we've got our butterfly here that we created. If I set the slices, let's just go to 1 standard deviation or something like that, and look at this probability. So I have, the stock is at 110.06, it says right here, right? And this is a neutral butterfly. This is a butterfly where you're targeting the stock to be between 100 to 120. And all I've done is basically set the probability to show me the 1 standard deviation move. 1 standard deviation is a probability that it will end up in that range 68% of the time. Now, this is not an exact science. This is according to how the options are priced. It basically projects the implied move is that the stock will be in this range between 102.10, see that's the lower end, and 117.40. It's projected to be in that range 68% of the time. See the price slices between where we're at down to 102, there's a 37% chance. From 110 up to 117.40 or so, there's a 31% chance. If I add those two together, 37 and 31 gives me 68. So it says that 2 times out of 3, that 68% of the time, and I realize that's not exactly 2 times out of 3, but close. 68% of the time, we should be in this range. So my butterfly captures that mostly, right? If I buy this butterfly, it's not perfect, but I'd have break evens that are kind of in here and in here, and this would be my profit zone, something like that. Well, I'm in that area. Now, could it end up out here? Could it end up out here? Sure, it could. And, I could even set price slices towards my break evens. I could say, what's the probability that it's going to be within my break evens on this trade? And whoops, we need to go to this date here. Okay, and it would give me a range and a probability, and it tells me that I've got about a 47% chance of being in here. My reward to risk ratio on this, if I pay 485, that's my max risk. 515 is my max reward. Why? So I've got this butterfly, this $10 wide butterfly. So that's the most I can make. This is the most I can lose. Some portion of that profit, there's a pretty good chance I can make that. Again, none of these numbers are an exact science. It's just this tool trying to kind of help you analyze some things. So in this particular trade, where you have a 1-to-1 reward to risk ratio, my belief is, again, that I cannot risk all of this to take smaller profits. But if this were different, what if instead of that, well, let's stick with this first. If I lose all of this, but I take this trade off early, let's say it's working and it's kind of just chopping around and bouncing back and forth, and we can even set these slices to the chart itself. Pull up the chart. Well, if I look at some of these levels and it's just bouncing around and kind of going sideways in here, if I take it off early for $1 profit or $2 profit, that only works if I'm going to take it off at a loss for less. That's the risk to reward started at 1-to-1. I can't change the trade midstream and all of a sudden go to, a risk to reward that's backwards, where I'm going to make $1 if it works out, but I'm going to lose $4.85 if it doesn't. This is not a good situation. But could I lock in a profit of, $1.50? Sure. If you're going to keep your loss at a lot less than $4.85. Imagine you were going to keep your loss at $1. If this trade drops from its current value of $4.85 to $3.85, you're going to take it off. You'd lose $1. Well, if it grows in your favor and it goes up to $1.50 of value, now I think you can do that. Does that make sense? So in terms of the trade, in terms of the positioning and whatnot, you have a situation where basically you're in a position that can make you money in this trade that's less than your max reward, as long as your max risk is kept at less than that as well, right? So that's the breakdown of it. So this is a butterfly. This shows the graph of, well, yeah, it's not this. I wasn't even looking at this part of it, but a risk graph on a butterfly should look like this. So yeah, it's not pulling all of that. Let me see here. But I was just looking at the price slices. I wasn't even worried about that aspect of it. Well, let's try it again. Yeah, it's not pulling all of those. Let's see what's built into this, why it's not pulling that. I'm not sure. There we go. Yep, it was pulling that other piece. It was pulling a 114 call in here. Must be something that somebody's paper trading. But anyway, if you look at this from the standpoint of risk and reward and so on, now you've got your breakdown of there's your break even, there's your break even, here's the risk graph we were talking about. Okay, perfect. So, but what I wanted to focus on, we know all that, right? We know that our risk was 485 and our max reward is 515. Now you can see it. Actually, we'll adjust it one more way. Let's go like this. We want to go 1 on this and just keep it really simple. And now you can see, perfect, there's your 515 or 515 max profit. Here's your 485 max loss if it were to go either way that way. And then here's your kind of probability of success area and so on. Here's your break evens. So if you're looking at it from the risk graph, shows you the same concept, which is, what I wanted to emphasize is, if this is highly likely where we're going to end up, of course the trade should start to build some profit along the way. but you got to make sure that you're not cutting those off too early and then leaving the risk side exposed. So I hope that makes sense. Yeah, how would you look at that? So you've got to plan for this ahead of time. You always have to look at this from the standpoint of risk reward probability and then game plan ahead of time. So, I do this on out of the money butterflies. I have a trading strategy where I'll put on, this one's a neutral. It just made it easy to teach. But if I had done this, and this is what I was talking about earlier, let's tweak this. Let's go out of the money on these. We'll go 110, 115, 120, or something like that. So now look at it and you say, okay, well, stock's at 110 and it needs to go up to be profitable. And here's my ideal target at 115. And then if it overshoots the mark, I'm in a problematic situation. Well, the good thing about that is this isn't going to cost 485. This is going to cost us, I don't even know. I'm going to guess $1.25 or something like that. And we could refresh. Should be able to refresh. Okay, 139. So if we want to be specific, I made a pretty good guess at it. So 139 is our max risk. So we have 139 max risk if it's outside of that range. We have 139 versus a $5 spread. So 5 minus 139 is 361, if I'm thinking of that right. So 361 is our max reward. Okay. Well, now I can take an early profit as long as, again, and I like to cut off these losses. You'll notice when I trade out of the money butterflies, I don't always do it. But sometimes I'll live with the risk to reward. Sometimes I'll be able to cut those off early. There'll be times where, it's not working. I was risking 139 in this. It's down to 80 cents. I'm just going to take the 59-cent hit. I'm just going to take that loss. Or this trade is working. I bought it for 139 and now it's worth $3. So I'm up in the trade $1.61. Okay, I'm going to lock in half of the profits and leave the other half on. Again, always mindful of risk and reward. If I take half profits at 161, I'm taking more profit than my original risk. I still have half on that can grow to an even bigger profit of 361. And if it hadn't worked, hopefully most of the time I can take those off and unwind them for less. So that can be a good approach to it, right? Where I always think about, for me, it doesn't make sense. Even if I think the trade will probably do this, if this trade is in my favor by 20 cents or 30 cents, and I'm like, well, it's probably going to fail or something. Sometimes you almost have to look at it as, well, I think that might happen, but what? It might happen 60% of the time, and the other 40 it keeps working. Sometimes you have to weather the storm, even though your opinion is, I could have an opinion on something every single day. Every single day I could look and be like, well, UPS is probably going up to tomorrow. Oh, now it's going to go down tomorrow. I could have an opinion on those little tiny moves. That doesn't mean I should be doing anything with my trade. And that gets a little tricky where a lot of times we want to predict everything and micromanage those positions, and that becomes a problem. So anyway, that's kind of the concept. So hopefully this has made sense where, management of a trade, the real concepts are, how do I lock in profits along the way? How do I minimize if it comes back against me? How do I try to maximize that profitability? And should I do anything with them? Should I stick with the reward and risk? Well, if you'll cut off your losses at lesser losses, then yeah, you can cut off your gains at lesser gains. If you don't do this, then don't do that. They go hand in hand. So good stuff. Thanks again, everyone, for being here. Hope you enjoyed it. We'll see you next time. Goodbye, everyone.